Welcome. Let me give you a little overview of what we're going to try to accomplish in this section here. Where we've gotten so far is our central organizing concept, price equals expected discounted payoff. We got there by thinking about payoffs, a random thing that might happen tomorrow, say, $1, $2, or $3 with associated probabilities. We thought about an investor with a utility function, and we realized that investor would value this payoff by our grand formula, price equals expected discounted payoff. That's the general version of it. As a warning, I sometimes leave the T's off when you're supposed to know where they go. We looked at that in terms of utility functions. So the discount factor was this ratio of marginal utilities. And we used an example power utility, which we'll keep using throughout. It's not the most general utility function, but it's a very handy one to work things out and see how they work. That's where we got. Our basic concept of valuation here was willingness to pay. We worked out what an investor with this utility function and that consumption would be willing to pay for a marginal little bit of the asset. And that was our concept of valuation. What are we going to do today? We're going to do basically all of the big concepts in the theory of finance that we'll do throughout the course. Today's sort of a preview version of that. First thing we have to do is meet the players. Returns, excess returns, present values, and how do you state this in continuous time? It's just restatement of the same ideas with the kinds of concepts like returns that you've seen in our facts day that people in finance use. Thom and French looked at expected returns, for example. We have to think about returns. Then once we've recast these ideas with those players, we'll look through the classic results in the language of finance, if you'd like. We'll look at where interest rates come from. We'll look at risk premiums, and we'll discover that covariance matters. The variance of an asset doesn't matter. It's the covariance that really matters. We'll look at expected return and beta representations, like the Fama-French paper that we looked at previously. We'll learn about the mean variance frontier and all of its magic properties. We'll look at random walks and efficient markets and that set of thoughts about the time series evolution of asset pricing. And we'll think about general equilibrium. How does this sit as part of a larger economic model? And the question of causality, which is the chicken and which is the egg. Ready to go? Here we go. Before we do the classic ideas of the theories of finance, you got to meet the players. We got to think about returns, present values, the other ways of stating the basic representations. So that's what we're going to do now. Alternative representations of our price equals expected discounted payoff ideas, returns, present values, and how does this stuff look in continuous time. So let's start with a return. A rate of return is just a price one security. You put in $1 today and you get back what you get in the future. Therefore, price equals expected discounted payoff just reads 1 equals expected discounted return. So that's the version of our basic formula when the thing we're looking at is a return. Now we thought of this as x determining p, and now r is in here. And you can think of this one also as determining the rate of return. A low price today is the same thing as a high return from today till tomorrow. It kind of expressing things in terms of returns sort of hides that, but that's what's going on. If you have a security whose price is driven down today, that's the way that it gets a high expected return from today until tomorrow. So this equation is still determining returns in the same way that equation you can think of as determining the prices. The return concept that we're using here, capital R, is a gross return, price plus dividend over initial price. It's a number like 1.1, not a number like 0.1 or 10% or annualized. People use lots of different units. When you deal with data, make sure that you're using the right set of units. Next, the most common kind of return is the risk-free rate. That's the benchmark that we start at. So what does our basic model say about risk-free rates? Well, 1 equals E of MR. That's what we've gotten to so far. A risk-free rate is risk-free, so it comes out of expectations. And therefore, the risk-free rate is 1 over the expected discount factor. So we've got our first case where very clearly you can see discount factors are determining something about returns. And the mean of the discount factor codes the information in an asset pricing model about the level of the risk-free rate. Another way of looking at risk-free rates, instead of you put in $1 and you get like 1.01, that's a 1% risk-free rate, you can think of it as a bond price. And we will do a whole week on bond pricing. A zero coupon bond pays $1 for sure tomorrow. So its payoff is 1, and its price is E of M times 1, or just E of M. So the same idea shows you the mean of the discount factor tells you immediately today's bond price, and the risk-free rate is, of course, 1 over today's bond price. How do we apply the same idea to excess returns? We use excess returns throughout finance. Excess return is the return minus the risk-free rate, or a difference of any two returns. Now, an excess return has a price of 0. You can see this two ways. One is you're differencing those things, so the difference of the prices is 0. Another way of thinking is, what is this object? You put no money down today, you borrow $1 and you invest that $1, so no money came out of your pocket, the price is 0. Price being 0 doesn't mean the return is 0. You've entered a bet. A bet is another example of no money changes hands today, but then money changes hands tomorrow. Well, with a price of 0, our basic equation is E of M 0. Price 0 equals E of M times RE. Again, it might look confusing if you thought we were determining prices, but no, the price here is given. If the price in some sense falls, that has to change the characteristics of the excess return. It has to promise you more excess returns. Another example, a bet is an example, leverage is an example. In other words, borrowing money to invest. A long-short position is an example where you short sell one stock and invest in another stock with no money coming out of pocket today. We look at these a lot because they're very common in the finance world. We look at them a lot also because they help us focus on the question. When you're not putting any money down today, excess returns focus on the risk element. It's all about taking risk. It's not about putting money down today and waiting till tomorrow. So we'll look at a lot of excess returns. Present values. Let's look now at a long-term asset, an asset that pays a stream of dividends. So XT now will represent the dividends paid on each date forevermore in the future. I'm using X, not D. I'd love to use D, but D gets used for derivative. So that's why I'm going to use that notation. But often I and other people will use D, so you got to keep those straight. What does the present value formula look like? Well, the price today is the expected discounted stream of payoffs. Each payoff gets discounted exactly the same way as we've discounted the one period payoff. In the case of our power utility function, it's CT plus J over CT to the minus gamma. It's that discount factor applied to the T plus J dividend. Or let's write it in discount factor notation. Now we will have a separate MT to T plus J, a discount factor from time T to time T plus J, which is just the ratio of marginal utilities. This is worth looking at now because this is the one that helps us make that jump to hyperspace, to continuous time. The analog of the present value formula in continuous time you can just write down. Now it's going to be an integral instead of a sum, and an exponential instead of a power. The ratio of marginal utilities is the same, and a flow of dividends. Or in our power utility function, e to the minus delta instead of beta to the j, the ratio of consumption and the flow of dividends. And that lets us define our discount factor. We'll define in continuous time a discount factor, lambda, which is the level of consumption, not the ratio of consumption. So that's what our general formula looks like in continuous time, a ratio of discount factors, which is the ratio of marginal utilities. Now, why does it look a little different? Well, as you saw when we were looking at continuous time likes levels. It likes to look at ZT, the level of the Brownian motion, not epsilon, the differences. So continuous time will define the levels of marginal utility rather than defining right away their differences. So these are clearly related. The multi-period discount factor is the product of intermediate discount factors, and that is the ratio of the continuous time level of marginal utilities. Where did that come from? I just plopped it out, didn't derive it. Well, you can derive it on your own, but the basic idea is pretty simple. Your utility function now extends over the entire future. So the investor now looks over an infinite future discounted, or in integral notation, the investor looks over an entire future geometrically weighted, and I need a dt there. So, and then with this infinite period utility function, you think about eating a little less today and then consuming the dividends in the future.
So, Professor, how would you deal with stocks that don't pay dividends?
Right. So let's look at the formula. Always a good idea. Price is expected discounted, what I've called dividends. Now the X here represents all payments that shareholders eventually get. So that would include explicit dividends. That includes long future dividends. So Microsoft didn't pay dividends for years, and then eventually they built up so much cash, they started paying it out to shareholders. Shareholders knew that that was going to come eventually and were willing to pay a price for it. Or the company could be bought out, or the company could be liquidated. Somehow or other, shareholders get the money. If there were a security where we knew the shareholders were absolutely never going to get any money, it shouldn't be worth anything. But the concept X here is more than just ordinary dividends. It's all expected future cash payments to shareholders.
Okay, great. Thank you.
Next, how are returns and present values related to each other? Well, you can sort of see right away that a return is something like a first difference of the present value relationship. So we have to make that clear. How do you do that? In discrete time, it's pretty easy. The price is the expected discounted payoff. And if you just group all the t+1 terms, the price is the expected value of tomorrow's price and tomorrow's dividend. Well, tomorrow's price and dividend divided by today's price is just the rate of return. So what we've done here is from the present value, we've sort of differenced it to get our 1 equals EMMR relationship. Right? So you can go from present values to return relationship, and backwards, you can accumulate the return relationship to find the present value formula. One's just the difference of the other, one's the integral of the other, with quotes around that difference and integral. Now, how do we do that in continuous time? We need to get to the concept of a return in continuous time, and that's going to be our way of doing it. So what is a return in continuous time? Well, I'll use the notation DRT for a return. That is the change in price plus the dividend paid divided by the initial price. As we let the delta shrink, DRT becomes the growth in price plus the dividend payout. And as you can see, that concept is a little different. It's a net return. It's the growth in price. We've subtracted off the initial price. Well, to go to continuous time, we have to do D's of things. And that's why in continuous time, we look at this net return concept rather than a gross return concept. It's also, sometimes it's convenient to keep track of the actual price and dividend and think of the return as the growth in price plus the dividend payout. It's also convenient to define dV over V this way. So V here is a cumulative value process. What that corresponds to, this corresponds to if you bought the stock, you have the price P and you get to eat the dividends X. V corresponds to the idea of put the stock in a fund where all the dividends are continually reinvested, and then V is the price, it's the value of that fund. It's sometimes convenient to look at that way, sometimes convenient to look at that way. Choose whatever's more convenient. So this DR concept will typically also be a diffusion process. It'll have a mean and it'll have a Brownian element. Returns move around a lot through the dP over P term, which will have a Brownian element. The X typically will not have a Brownian element to it, at least in the simple versions we do. Okay, now what did we do in discrete time? In discrete time, we defined a return, and then we could have found 1 equals E of MR by differencing our present value relationship. That's our key to how do we think about, how do we express P equals E of MX for returns in continuous time. You start with the present value relationship, price is expected discounted payoff. Then let's first difference it. Our first step is we break it up into what happens in the first delta instant and then what happens from delta to infinity. You recognize that as tomorrow's price, right? The delta to infinity, that's just the price tomorrow. So we have price today, we have a little bit of a dividend payment, and we have a price tomorrow. I'll apply the famous ... operator, by which I don't show you all the algebra, and you go read that in the notes. But you take that, and then a couple more steps, you get to our expression for the equivalent of 1 equals E of MR in continuous time. Let's look at what it says. I have 3 different expressions. Some are more convenient than others in different ways. One nice way to write it is that 0 is the expected change in discounted value. You might think that values shouldn't be expected to change, sort of random walk idea. That's almost right. It is the discounted value that should not be expected to change. Another way of writing that is that 0 should be the flow of dividends, which is deterministic, plus the expected discounted change in price. Or I really don't need that lambda v on the bottom. I put it in there, you'll see it's convenient. It can go in and out of the 0 as you'd like. But another way of writing it, the purest analogy to 1 equals E of MR is 0 is expected change in discounted value. We'll make that more intuitive in just a second. Finally, so what does the risk-free rate look like in continuous time? Well, a risk-free rate is just a rate of return that doesn't have a DZ term in it. You know ahead of time what the rate of return is going to be. So the rate of return is RF times DT. There's no DZ term in a risk-free rate. Now, the value of the risk-free rate can change over time. It's not fixed in that sense, but at any instant, how much you're going to get over the next instant is sure, because there's no DZ term in the risk-free rate. There's two ways of thinking about a risk-free asset in continuous time. One way of thinking at it is a cumulative value process. In other words, you put in $1 initially, and then B is the value in your account. Say you put it in a money market fund and just leave it there. The value in the money market fund grows over time, and the rate it grows deterministically at the risk-free rate. Another way of thinking of a risk-free asset is that the value is always 1, but it pays you a flow of dividends equal to RFDT. So they are actually, the way money market accounts work is the value is always 1, and then they send you a check every month for the amount of the interest rate. Both of those are ways of thinking of the risk-free asset. They both have that property. What have we done? We've taken our basic ideas of price equals expected discounted payoff and re-expressed them in terms of returns, excess returns, present values, and returns and risk-free rates in continuous time. Once you've met those characters and seen how our basic asset pricing formula applies to them, then you're ready to see the classic statements of the theory of finance about how returns, excess returns, discrete time, and continuous time are determined in how they behave. So now that we've met how returns work, we can talk about some of the classic issues and propositions of finance. Let's start with the risk-free rate. Where we got to in thinking about risk-free rates was RF is 1 over E of M. Let's look at that a little more closely. Now, our prime model for M, the discount factor, is 1 over expected beta consumption growth to the minus gamma. And now you kind of have a yuck ahead of you. You're taking the expected value of something raised to a power. It's nonlinear. It's a 1 over. And it would be nice to do some approximations. Here's where continuous time comes to the rescue. And this will be one of your first big payoffs for having invested in continuous time. You'll see how we surmount all these nonlinearities by doing a continuous time approach. So, as a reminder, how does continuous time work? Last time we thought about what our basic P equals E of mx looks like in continuous time. 0 equals E of d lambda v. Let's apply that to the case of our risk-free rate. So our basic condition was 0 equals E of d lambda v. I like it in proportional form. Use Ito's lemma. D of lambda times v is d lambda dv, and then the cross term. Don't forget those Ito's lemma cross terms. So that's expanded our basic first order condition for an asset with cumulative value process D over V. A risk-free rate has a cumulative value process. I call it B because for bond, that's a tradition. It only has an RFDT term, so this Ito term is going to vanish, right? Because if that only has a D term, that times that is going to be of higher order. So the only terms left now are the d lambda over lambda and the dv over v. Therefore, RF, that term, becomes minus E of d lambda over lambda. You can see clearly how that equation is the continuous time counterpart of that equation, and that you get a minus rather than a 1 over, which is the simplification, kind of simplification that you get out of Ito's lemma and continuous time. Well, that's a little bit of progress. Now let's try to put the consumption back in. So our continuous time discount factor is e to the minus delta consumption to the minus gamma. We use Ito's lemma again. So let's use Ito's lemma to express d lambda over lambda in terms of consumption properties. So what does Ito's lemma give us? We have the derivative with respect to time, the derivative with respect to consumption, and the second derivative with respect to consumption. Don't forget those Ito's lemma terms. That's a general result that'll be useful for us. Now let's look at it a little more. What does this mean? If consumption, for example, follows a diffusion process with a drift and a diffusion, that means that the discount factor has a drift term, which is the delta term. It's the drift term of the consumption that comes out of here. The diffusion term comes out of there, so there's the drift, and then the same sensitivity to the consumption shocks. So now we know how to connect the discount factor to the properties of consumption, and that's, notice it's all linear. That's gotten us around this to the gamma part. Okay, now we plug it all in, and we've got a pretty answer. RF is minus expected discount factor growth. Discount factor growth is this term here. So what do we get? The expected value of that is the drift in consumption. So we just take expected values. The risk-free rate is delta, that's that term, plus gamma expected growth in consumption, minus 1/2 gamma gamma plus 1 times the variance of consumption growth. That's the continuous time version. Now we can just read from that the discrete time approximation. We've been looking for an approximation to that thing. So in discrete time, the risk-free rate is the delta term, gamma times expected consumption growth, and gamma gamma plus 1 times the variance of consumption growth. Now you've done a lot of work. Let's sit back and enjoy the beauty of what we see. We have here a theory of where interest rates come from. What makes interest rates go up or down? Well, first, delta, impatience. If you live in an economy where people are more impatient, interest rates are going to be higher. Interest rates are about what does it take to get people to save some of their income, not consume it all today, and consume some tomorrow. Well, if people are more impatient, you have to pay them a higher interest rate to consume tomorrow rather than today. Next term, intertemporal substitution. This says that interest rates are higher when consumption growth is higher. Now let's think about that. That seems kind of strange. Here's time. Think about consumption growing at CT to CT plus 1. Why do you have it? If that's a high consumption growth, why are interest rates high? Well, high consumption growth means that consumption is low today. If you knew you were going to be really rich tomorrow, why not go out and have a nice dinner tonight? Well, in order to keep you from consuming all of that stuff today and waiting till tomorrow, we have to pay you a high interest rate to get you to substitute consumption from today until tomorrow. Gamma here acts as the intertemporal substitution elasticity. It controls how much do I have to bribe you with a higher interest rate to get you to consume less today and have a big consumption growth from today till tomorrow. The third term is precautionary savings. If you live in an economy with a lot of volatility, a lot of uncertainty, what happens then? Well, if you live in an economy with a lot of uncertainty, people are nervous about the future and they try to save a lot today. If people are trying to save a lot today, that's going to drive down today's interest rates. We're going to have a very low interest rate because everybody's already trying to save. Here, the gamma is acting as a risk aversion coefficient. It's telling us how much people react to uncertainty about the future by trying to put it all in matrices today. You can see gamma has the same coefficient as having two functions here, and we'll look later in the course at utility functions that separate those two functions and let people have different responses to consumption over time and aversion to risk. Now this is actually a very sensible theory. Let's think about what it says. This predicts that if there's a time when consumption growth is low, like a recession, like the one we've just been through, then interest rates should be low as well. Interest rates should follow expected consumption growth. You don't need any Federal Reserve, you don't need any surprises like that. This is just how an economy should behave and pretty much how the economy does behave. Variance too. If you go through a period of great uncertainty like the one we've just been through, that predicts that interest rates will be low as well. So this theory captures the main features of what we see in the data, even though it's very simple. So what have you seen? I hope this is exciting. You've seen the first example of our theory making a prediction about what an asset price should do. That prediction relates interest rates to macroeconomic events and how people feel about those events, and comes out to something that's at least on a verbal level plausibly true about how things work.
So in real life,
What do you mean real life? This is real life.
Okay.
Go ahead.
If I purchase a stock, the dividend payouts aren't, every single instant in time. So in that sense, the X is a discrete process. But so what we're doing here is we're taking the continuous time analog to sort of approximate this discrete process. And what we're doing is we're breaking it up pretty much using Taylor's rule and Ito's lemma to get back another, the continuous time analog. So we have two approximations going on. Is there any big issue in terms of trying to match this to the data?
So in many, many ways, I'm presenting the simplest possible version of the theory so we can get the ideas right. Where that shows up is right here. What I assumed here is that there is a constant flow of dividends per unit time. I mean, literally, they are sending you a cent every second. So, exactly. Now, it's not at all hard to generalize this formula to let them, rather than giving you a unit, a flow of dividends constantly, we could have them give you lumpy dividends every now and then. You could have no dividends for a while and then a big terminating dividend. We're using diffusions. The general theory allows for jump processes in all sorts of places. So I would just advocate, let's understand it all with the simple version, and then adding those kinds of realistic things. Now, that's important when you get to data. When you get to data, you have to know that the dividends come boom. And typically what happens is the price goes down the minute the dividends are actually paid. But for conceptual purposes, that's what I'm doing.
Okay, so to estimate it, say I want to use GMM or whatever, should I try to take into account, like sort of rederive this with a different distribution going in?
I'll just say yes. Use formulas more like the reality of the securities you're actually using. There's a larger art of approximation. So where does it actually cause problems to use a slightly too simple formula? There's all sorts of realities that we often gloss over. Sometimes they matter, sometimes they don't. That's an artistic question.
Okay.
So now let's think about risk premiums. Risk premiums are really the heart of finance. Let's start by looking at our basic price is expected discounted payoff formula. And I want to break this up. One of the central tricks, I'm going to break E of mx up using the definition of covariance. This is just the definition of covariance is E of mx minus EM/EX, so I can turn that around and break it up this way. We know what E of m is, that's just the risk-free rate. So now we've broken up the price into two components. The first, E of x over RF, and the second, covariance of m and x. This is a beautiful formula. E of x over RF is just the standard discounted cash flow formula. Take the expected payment, discount it by the risk-free rate. Wait, you say, that's wrong because it doesn't include corrections for risk. That's exactly right. We now have broken it down into the time element, captured by interest rates, and the risk element, which is generated by the covariance of the discount factor with the payoff. The covariance is what determines the risk premium. That's the central lesson here. Let's express that in terms of rate of returns, which is more traditional in the finance and in the empirical literature that we want to connect to. So we can break up any return into the risk-free rate and then the return minus the risk-free rate, or the risk-free rate plus the excess return. And again, the risk-free rate captures the time element, and the excess return, which is a zero-cost portfolio, captures the risk element. So starting with our basic equation for pricing and excess return, let's break it up similarly into the product and the covariances. That's just E of excess return over risk-free rate plus the covariance. And now turn it around, put the expected return on the left. That's the tradition in finance. Let's, instead of trying to understand prices, let's understand expected returns. It's the same idea, of course. A low price, if that's time and that's price, a low price is the same as a high expected return. So it's the same idea. So what do we learn? Expected returns are equal to the covariance of the discount factor with the returns. Or the original return is the risk-free rate plus the covariance of the discount factor with returns. We're almost ready to do what we just did with interest rates. We're almost ready to plug in M for consumption growth and start learning about the macroeconomic determinants of risk premiums. Where do they really come from? Why do some securities pay higher average returns than others? That was the exciting question we started the whole class with. But if we plug M in here, again, we've got this thing with the nonlinear consumption growth to some power, and then we start doing approximations. Perhaps, again, by going to continuous time, the continuous time limit will be linear and simple for us. And that's exactly the way it is. So we've learned that covariance drives the risk premium, not the variance of the return. The low price is what generates a high expected return. So these two ideas are similar. And risk premiums are really important. If we look at just the stock market in general, the stock market's average return is about 8%, of which 2% is risk-free rate and about 6% is risk premium. So the risk premium is central to understanding stock market returns and everything in economics and finance. Okay, to continuous time. How do we do that? Let's go back to, we had our continuous time formula, E of d lambda v. We broke that out into, by Ito's lemma, d lambda, dv, and the cross product. And now we know what to do with each of these three terms. E of d lambda over lambda is the risk-free rate term. E of dv over v is the expected return. That's the kind of object we're looking for. That's good. And now we have that term, which is the covariance of discount factor growth with return. So let's plug this thing out on the left-hand side. Expected return is risk-free rate minus covariance of discount factor growth with return. That is, now you can see an equation that is transparently in continuous time exactly the same form as the one in discrete time. E of d lambda v didn't look a lot like 1 equals E of mr, but expected return is risk-free rate plus covariance with discount factor. That is a clear expression in continuous time of the same discrete time idea. And fortunately, we lose that RF in front, which was kind of annoying in the discrete time case. So now we're ready. What have we done? We've thought about risk premiums expressed as expected returns in continuous time and discrete time. And now we're ready to put consumption in and start thinking about the macroeconomic determinants. Where do risk premiums really come from? So we've got expected excess return is risk-free rate plus, and now d lambda over lambda was just the only term that remains is the Ito term. The only term that remains is the one where the shock to consumption growth hits the shock to return. So all that remains is expected return is risk-free rate plus covariance of consumption growth with return multiplied by the risk aversion coefficient. Or the discrete time approximation we were looking for, expected return is risk-free rate plus covariance of consumption growth with return multiplied by risk aversion coefficient. This is just a beautiful formula and the heart of all of finance. What do we learn? First, the ingredient. Investors care about consumption. They don't care about the return of the securities. They don't care about the portfolio return. They don't care about the stocks they hold. They care about consumption. So why is it that covariance rather than variance of return is what drives the risk premium? Because the covariance of a return with consumption growth tells you how much does buying a little bit more of that asset affect the volatility of your consumption growth. And that's what you really care about. You don't care about the asset per se. You care about the consumption growth. If you were asked, do you want a steak? We have to ask in the context of what overall dinner? That's what's going on here. If you're asked, do you want some of this return in the context of what does it do to your overall consumption growth? As an example, a good example, you might well buy securities with terrible expected returns. You are. If you have car insurance, you have a security with a terrible expected return. Why do you hold a security with terrible expected return? You're paying them more than they pay you. Because they pay you on days when your car just got stolen. They pay out very well. Their payment is very good. It's negatively correlated with consumption growth. They pay well on a day when your consumption is terrible because your car just got stolen. Conversely, most securities pay well when you're already doing well, and that's why you require a high risk premium to be forced to hold it. Let me show you just a simple example to drive home why covariance matters. Consider two securities. The security has payoff X, or excess return if you'd like, X or RE, doesn't matter which we call here, which is either +1 or -1. And the probability is a half of +1 or -1. Well, there's security A and here's security B. They both have, that has +1 and -1, this has -1 and +1. Do you care which one you own? From what I've told you now, they look identical, right? Who cares which state the plus and -1 is? But now let's suppose that this security is in a state where consumption is good and that's consumption is bad. Whereas this again is consumption is good and that's consumption is bad. Now compare the two securities. This one gives you more money when you're already feeling great and takes money away when you're feeling terrible. This one gives you money when you're feeling terrible and takes money away when you're feeling great. This is a much better security for you to buy. That means, however, you will drive its price up and you will drive its expected return down. So the expected return will be low on this security because of its covariance with consumption growth, having nothing to do with its variance or other properties. So next, let's think about risk premiums and betas. Where we were is we had expressed expected returns, the risk premium, in terms of a covariance with the discount factor or in terms of a covariance with consumption growth. I emphasize that covariance, not the variance of the return, matter. It's more traditional in finance to express expected returns in models with regression betas on the right-hand side. And it's easy enough to get to that representation. Let's just take that covariance of M with the return and multiply and divide by the variance of the discount factor. Or with consumption growth, let's multiply and divide by the variance of the consumption growth. Put all the other stuff in parentheses over here. And then covariance divided by variance is a regression coefficient. It is, by definition, a beta. So we write the same model as expected return is proportional to beta times a parameter known as the market price of risk. These are called market prices of risk. I've added an I here to emphasize the point is to distinguish why some assets are different from others. So I is different from J. Why is asset I different from asset J? Why do value stocks pay more than growth stocks according to this model? Because asset I has a different beta than asset J. They all share the common lambda. So the beta, the covariance, is the thing that makes one asset different from another. This notation suggests the common procedure. How would you go about checking a model like this? How would you use a model like this? Well, you could do it in 2 steps. To evaluate the covariance, your first step is you run a time series regression. You run over time the return on an individual asset on a constant on consumption growth. I'm doing my second model. And this regression is run over time for each individual asset. The point of that regression is to find the beta coefficient, the tendency of this asset to fall in times when consumption falls. Then that's an input to the model. The model says expected returns should be high where betas are high, and the lambda, the market price of risk, is the slope coefficient relating expected returns to betas. Alpha is what is the word Greek letter we use to talk about deviations from the model. So I put it in parentheses. It shouldn't be there, but if it is there, we call alpha the deviations. It's the expected return over and above compensation for risk generated by the model. So graphically, the standard picture of asset pricing looks like this. This is what the world should look like. If you took all securities and lined them up by their betas, some securities, like interest rates, they're constant, they don't have any beta. Other securities, when consumption growth goes up and down, they have whatever betas they have, but their expected return should line up with their betas. The ones with higher tendency to fall in bad times have to pay their investors higher expected returns to get those investors to hold them. Lambda is the slope coefficient in this relationship. When you get a higher beta, that tells you how much more expected return you have to pay. And alpha is what we call the deviation from the relationship. Here's an asset with alpha. It's giving its investors higher expected returns than the compensation for risk that they should need to get. So just multiplying and dividing gets us to the standard expected return beta style of model. This is the consumption capital asset pricing model. Now, a few comments on this model. First of all, the notation is traditional, but watch out here. Expected return is the thing we're trying to explain, and beta is the right-hand variable. We're used to beta being slope coefficients, but no, in this cross-section relationship, beta is like the x, expected return is like the y, and lambda is like the slope coefficient. Beta is the thing we're using to explain expected returns. Another way of seeing the difference, lambda, the market price of risk, is the same for everybody. Right? There's no I in here. There's no I in there. Beta is the thing that's different from one asset for another. This relationship, usually market prices of risk are just taken as free parameters. That's kind of cheating, because this shows us that a model tells us what the market prices of risk should be. The market price of risk is higher if you live in a risky economy, or if the risk aversion is higher. Naturally, if it's either riskier or higher risk aversion, it's going to take more expected return to induce investors to hold those assets that are risky in terms of high beta. The I notation emphasizes most of the common ways of misunderstanding this. What is this about? What is this statement trying to tell us? It's about why some securities have higher returns on average than other securities. Why did the value stocks for Fama French have higher returns on average than the growth stocks? It's not about why returns vary over time. Why is there this crazy volatility of returns? That we can address. That's not what this model is trying to talk about. It's not about why did IBM go up yesterday. It's about the expected return over long periods of time. And it's not about which is going to go up tomorrow. We're not trying to predict stock returns over time. We're trying to understand why long-term average returns are higher on some securities than other securities. That's what the E part means here. Again, I emphasize it over and over again. It's one of the classic theories of finance. What does this tell us? It tells us that the variance of the return does not matter. What matters is the beta, the tendency of the return to fall in bad times as measured by consumption growth. Another way of saying that same classic proposition of finance is that only systematic risk is priced. What do those words mean? Well, think of running a regression of the return on the discount factor or consumption growth and a residual. That breaks apart the volatility of this return into two components. The volatility of the return is the component correlated with the discount factor or with consumption growth, and an idiosyncratic component. Since those are regression, those two things are uncorrelated with each other. So variance of return, it doesn't matter. Variance of return, you can break it apart into two components. The systematic component, this varies with the discount factor, and the idiosyncratic or diversifiable component. Another way of saying covariance is what matters is that only the systematic component of risk matters. The idiosyncratic component of risk does not matter. Only the part perfectly correlated with them generates a risk premium. You've seen here a first example of what we mean by an asset pricing model. We have a general theory in terms of a discount factor, but to make it operational, to know what to run regressions on, we need something to translate, to connect the discount factor to real data. What I've done here is I've used a utility function to connect the discount factor to consumption growth, so we run regressions on consumption growth. Where we're going is other kinds of asset pricing models, which will work the same way. We'll use other theoretical ideas to connect the discount factor to other kinds of data. Fama and French's paper connected the discount factor to the returns on a value portfolio, a small portfolio, and so forth. Well, we'll have to think about that, but this shows you the logic of an expected return beta asset pricing model and shows you where these classic propositions about the nature of risk and risk premiums in the theory of finance come from. So next in our tour of classic ideas in finance is the mean variance frontier and the Rolle theorem. This one actually takes very little algebra. Let's start with our basic pricing equation for an excess return. 0 equals expected discounted excess return. Break that guy up again by the definition of covariance. We've done that one before. And now break up covariance into the product of standard deviations and the correlation coefficient. Next step, bring the expected returns onto the left-hand side. Bring the other stuff onto the right-hand side with the zeros, and you get the ratio of expected return to standard deviation of return equals negative standard deviation of m over mean of discount factor times the correlation coefficient between the discount factor and the excess return. Now, correlation coefficients have to be less than 1. Therefore, this ratio of mean to standard deviation can't be any bigger than the ratio of the variance of the discount factor to the mean of the discount factor. And using the standard continuous time approximation, the standard deviation of the discount factor is risk aversion times the standard deviation of consumption growth. That's it for algebra. Now let's look at what this means. First of all, this quantity, ratio of mean to standard deviation of excess returns, we use that all over the place. It's called the Sharpe ratio, after Bill Sharpe, who invented it. And it's a nice measure of security performance because it's immune to leverage. If the ratio of mean to standard deviation of the same security leveraged up twice is of course the same. So you can make mean returns look as big as you want by leveraging them up, but you can't change the Sharpe ratio. So this says the Sharpe ratios are limited. There's only so much Sharpe ratio you can find in any market. Now, so let's look at what does this equation imply. Here's the list of implications. First of all, there is a mean variance frontier, or a mean standard deviation frontier. You can plot mean versus variance or mean versus standard deviation. I've chosen standard deviation. This just tells us that all securities must lie in this green zone here. The ratio of their mean to standard deviation can be less, but it can't lie outside there. And this part here is called the mean variance frontier. It's the frontier. It's the best possible ratio of mean to standard deviation you can get. How big is the slope of this frontier? What is the maximal Sharpe ratio of any security that you can get? Well, it's higher in an economy with more risk or more risk aversion. Sensibly, the premiums you get for holding risk can be higher in an economy with more risk or more risk aversion. All frontier returns, the returns on the frontier, are, of course, generated by rho equals 1. That means all frontier returns are perfectly correlated with the discount factor, and hence they are perfectly correlated with each other. So although these are different returns, they all move in lockstep because they all have rho equals 1. That means the very famous two-fund theorem. The returns on the mean variance frontier are not really separate objects. As soon as you have any single return on the mean variance frontier, then every other return on the mean variance frontier is just a scaled up version or scaled down version of that one because they're all perfectly correlated with each other. We call it a two-fund theorem because if we look at the underlying returns, not excess returns, then there's the mean variance return and the risk-free rate. And so you need those two funds in order to generate any return on the mean variance frontier. That was historically very important when we thought people wanted to hold mean variance efficient returns because it means you only need two index funds. You don't need to hire people to charge lots of fees to create different portfolios for you. Finally, the Rolle theorem. The Rolle theorem states that there is a beta representation. So expected returns are proportional to the beta of returns using a mean variance efficient return, using RMV as a reference return, that thing on the right-hand side of our beta regressions, if and only if RMV is a return on the mean variance frontier. So if I find a return on the mean variance frontier, I have found an asset pricing model. I've found something that I can put on the right-hand side, calculate betas, and all other returns will line up. Their expected returns will line up with their betas. And the proof is just, again, it's a consequence of correlations being 1. If all the correlations are 1, that means that this return is on the mean variance frontier. It's perfectly correlated with the discount factor, and therefore the discount factor and my mean variance efficient return move in lockstep. So we started our search for asset pricing models, and this gives us an important insight. Any asset pricing model is the same as the statement that there is some return on the mean variance frontier. If Fama and French's asset pricing model is right, it means there's a combination of their value and small portfolios that is on the mean variance frontier. The capital asset pricing model is simply the statement that the market return is on the mean variance frontier. The market return is on the mean variance frontier if and only if expected returns line up with betas on the market times a factor risk premium. So that's a pretty remarkable set of theorems. Now, let's look at what I haven't said and that you might think I've said if you know a little too much about finance. I haven't said anything about returns being normally distributed. I haven't said anything about limiting the assets to stocks and not including bonds and options and derivatives and other things. I haven't said anything about utility functions, means, variances, quadratic utility, and so forth. Why not? Because of the things I'm not saying. I have not said that the market return is on the mean variance frontier. That's a restriction. That's a capital asset pricing model. And I've not said that any investor wants to hold a return on the mean variance frontier. Typically, they don't. Our larger models, the market return and investors' returns will be inside the mean variance frontier. Investors want to smooth consumption growth. They don't want necessarily mean invariance. There's a host of special assumptions where the market and investors hold something on the mean variance frontier, but we haven't made those assumptions. The mean variance frontier has this historically very important place in asset pricing because it comes from our early special assumptions that put portfolios on the mean variance frontier and put the market on the mean variance frontier. And it had all those special assumptions in it. It survives, though. All of these pricing results survive. And means and variances are still important. Why? Because our fundamental asset pricing formulas involve second moments. So when you're doing first and second moments, mean and variance frontiers are still important. They still carry all the pricing information, even though it's not necessarily true that people want to hold mean variance efficient portfolios.
Professor, why isn't this a hyperbola? The way we typically see the CAPM presented is there's the expected return, there's the standard deviation, and the frontier looks something like that.
Right. This is the standard. There's a risky asset frontier. I'll draw it a little better.
Right.
It's a hyperbola.
Right.
I've drawn this in front of classes many times. And then we add the risk-free rate and the tangency portfolio and all that business. So what's going on? Why does this look like this? Key difference. This is excess returns. So this is the mean variance frontier of zero cost portfolios, whereas the standard thing we draw is the mean variance frontier of actual returns that aren't zero cost portfolios. Zero is always an available zero cost portfolio. Put no money in, get no money out, right? That's the zero cost portfolio. So the mean variance frontier of zero cost portfolios is always a cone, even when, if there were only risky assets, even when the mean variance frontier of actual returns looks like that. This is much more convenient and simple, which is why I'm using it. That one's underneath it all.
I see. Okay, thank you.
So last stop in our tour of all the grand propositions of finance related to price equals expected discounted payoff. Random walks, time-varying risk premiums, market efficiency. Here we're thinking about the behavior over time. So far I've been thinking about why one asset earns more returns on average than another. Now let's think about assets' behavior over time. Let me just give you the intuitive idea first. Suppose we're sitting around and the stock market's at 100, but everybody thinks it's going to be at 110 tomorrow. What do? Answer, buy. And you better be quicker about it than that if you want to make money in today's markets. Now what happens if everybody tries to buy? Here's the situation. Price is at 110. Everybody expects it to be, price is at 100. Everyone expects 110 tomorrow. There's some distribution tomorrow, but the expected value is 110. Well, if everybody tries to buy today, of course they're going to drive the price up today, and they're going to drive the price up today right about until today's price is equal to the expected value of where it'll be tomorrow. So competition should drive today's price to the expected value of tomorrow's price. Turning that around, that means tomorrow's price should be equal to today's price plus some shock, some forecastable shock. Prices should follow a random walk. Now that's not exactly right. That's intuition. That's not exactly right. Let's do the exactly right from our discounted formula. Price is expected discounted payoff tomorrow, or the discounted price including dividends should equal today's price plus the shock. To be even more explicit, the discount, if you use the consumption-based discount factor, that's what should equal today's price plus the shock. But if you're looking at high-frequency data, especially days, weeks, even months, it's easy to show that most of this stuff doesn't really matter. The shocks are so big compared to that we're very close to the random walk in any case. Another touchstone coming back to our regular equations that'll be useful. Let's suppose that expected returns in continuous time are constant through time. So the expected return or the expected increase in the value process is just mu is constant, doesn't change over time. Then taking logs, the change in the log of VT, we have the ETOs term, or the log of the value process should be today's log of the value process plus the expected return term. The log of the value process should follow a random walk with drift. But the drift term for daily or weekly will be very, very small. So in fact, this is very close to a random walk as well. So constant expected return is the same thing as the random walk with a constant drift term. Time-varying expected returns would imply a time-varying drift term. Now, the random walk is interesting in its own right. It's a very interesting process. The crucial prediction here is that nothing else matters. Nothing but the current price should be helpful for forecasting future prices. If we ran a regression of price tomorrow on price today plus some other forecasting variable, that other forecasting variable should not enter. Why not? Well, if anybody could tell where prices were going tomorrow better than the price today, they would jump in, send the price today going up. This is the traditional concept of market efficiency. And it describes in a very deep way one sense of what's going on in all our asset pricing formulas. That the price today reveals all the information that there is about the expected value tomorrow, properly discounted if you're being careful, or just the price tomorrow if you're approximate and high frequency. And that's not something deep, as you can tell. It's just about competition. If the price today were too low, if there were some signal, then people would pour in. Competition would drive the price up today. It's a very simple proposition, very intuitive, but very deep. It says nothing else should be able to forecast prices. In particular, things that people love to do, like technical trading, shouldn't work at all. Just for fun, I've made a graph of a random walk. So this is a plot of, it's just a random walk simulated with parameters to look like daily stock price movements in a year. This is our completely artificial data. Yet your eye, the human eye, looks at this and so much wants to see patterns. And the statistical computer eye wants to see patterns as well. I mean, look at my plot. There's resistance levels. Every time the stock market hits the resistance level, it pushes back again. Then finally, when it breaks through the resistance level, the old trend is eliminated, and we're breaking into the new trend of the bull market. All sorts of stuff here. I see waves at regular periods. There's like a half a month wave, the Kondratiev wave cycle. Your eye just wants to see that. So does your computer. Standard errors of random walks are typically quite wrong. And that is a lot of fun, showing how all those things don't work or work a lot less well than people think. More implications. It says that the concept of price pressure, that if prices are driven down by a wave of selling and they'll bounce back in the future, or that long-run investors can afford to wait out these short-term price fluctuations, those are all wrong in a random walk. Those all reflect the view that if the price went down today, there's some sort of bounce back. Nope. A random walk, once it went down, it's down forever. And statistically, that's a very close approximation to what stock returns are. And this captures a lot of the ideas of finance. Now, the facts, as we've looked at the facts, it's not true. There are variables that can forecast stock returns. We ran regressions in the first day of returns on dividend yields and found that, in fact, you can forecast returns. What does that mean? Does that mean this is all wrong? No. The dividend yields move very slowly over time. But it does mean that we will have to expand our theory in order to take account of facts of that sort. So a forecast of return, the fact that you can forecast returns, that means, that regression means that expected returns vary over time. When dividend yield is high, expected returns are high. When dividend yields are low, expected returns are low. So expected returns vary over time. That means in our theory, the covariance of returns with the discount factor will have to vary over time. That means we will need time-varying correlations. That's too ugly to think about. But more likely, we will need time-varying risk aversion or time-varying riskiness. That adds a layer of interest to our models. Of course, there is time-varying riskiness. There's recessions, there's financial crises, there's times when risks are higher and times when risks are lower. So no surprise that expected returns vary over time. It just means our models are going to be more interesting. Another implication, let's look at it in terms of the discount factor. That means that the conditional variance of the discount factor has to vary over time. Expected returns, the slope of the mean variance frontier, were all related to the standard deviation of the discount factor. If expected returns vary over time, the discount factor must be heteroscedastic. That means simple linear models aren't going to work. When we construct models for bonds and options, we're going to have to think of models with time-varying variances of the discount factor, which just makes it more fun. Does this mean markets are inefficient? No. It's certainly possible, and even Fama's original essay pointed out that risk and risk aversion can vary over time. Now, it's more sensible if they're varying over time at business cycle frequencies in response to visible changes in the economy. If they were varying over time from Monday, Wednesday, Friday, you might think twice about it. But in fact, that's roughly where we see the time-varying expected returns. And last point, this makes an important connection. Forecasting returns is the same thing as saying expected returns, compensations for risk, risk premiums vary over time. So that's the new set of facts. It slightly changes the random walk, but it changes it at lower frequencies. There's slow movements in expected returns, reflecting slowly varying risk premia that will make our modeling effort much more interesting than it would have been otherwise. So let's talk about general equilibrium and causality. Motivate by a little bit of a puzzle. What we've done here, the finance approach, let's look at just the case of the interest rate equation. Interest rate is 1 over expected discount factor. And we read this equation as from the properties of consumption growth, this determines the interest rate. But macroeconomists and microeconomists use exactly the same equation in a different way. They just put the marginal utility consumption on the left-hand side. They write the equation this way. And then they say, no. This equation is how, given the interest rate, how consumption is determined. Macroeconomists say, given the Fed setting interest rates and expectations of future consumption, this is the equation that tells you where consumption comes from today. Microeconomists would look at this just as an apples and oranges bit of economics. There's an interest rate, there's a utility function, and that is how, given the interest rate and the utility function, the consumer decides on how much consumption. So what is it? Which is the chicken and which is the egg? Is it consumption determining interest rates, or is it interest rates determining consumption? Similarly, let's look at what we've done for risk premiums. We've written our basic equation. Expected return is covariance of return times consumption growth. with only one need for a risk aversion coefficient. And we read that as given consumption growth, given the covariance of consumption growth with returns, this equation determines expected returns. But wait a minute, consumption's an endogenous variable to the economy. Tomorrow's return is primarily determined by tomorrow's price. That's going to be the endogenous variable tomorrow. What are we doing saying that's exogenous determining expected returns? Well, to answer these questions, we really have to fill in the missing assumptions. We have to fill in the general equilibrium. Where does supply come from? What we're really looking at here is the demand curve. And to understand questions of what's the chicken and what's the egg, you have to do the rest of economics, where demand intersects supply, and that's what general equilibrium is all about. So let's run through a couple cases, and you can see how this exogeneity question can come out differently. Here's one case, the endowment economy, made popular by Bob Lucas in his famous paper. So one possibility for general equilibrium is we live in what's called the coconut economy. What we get to eat today is just how many coconuts fall from the trees, and that's called E, the endowment. If that's the supply of the economy, the production possibilities frontier, the technological possibilities for what you can eat today and what you can eat tomorrow, looks like a square. You can eat only so much as coconuts fall today and so much as what coconuts fall tomorrow, but there's no technological way for you to transform coconuts from today till tomorrow. Now, if that's the way the production side of the economy works, here's how general equilibrium works. And let's think through that general equilibrium. There's many people on this island. They trade and they can borrow and lend coconuts. So each individual says, I'm perfectly free to borrow and lend coconuts at the interest rate. To each individual, they face the interest rate and decide how much to eat each day. But of course, the interest rate has to adjust until the total supply of coconuts equals the total demand for coconuts. So from the economy's point of view, it is in fact true that the endowment is the exogenous variable and the interest rate is the endogenous variable. So if we fill things out with the Lucas view of the supply side of the economy and the general equilibrium, though to each individual, P equals E of mx is in fact, they take interest rates of given and decide their consumption stream. To the aggregate economy, it's the other way around. The consumption stream is exogenous, and shifts in the consumption stream will change interest rates. If more coconuts fall today, interest rates will change today. Now, case two, that's not very realistic. The traditional theory of finance posited a different production technology. The traditional theory of finance wrote down a process for the rate of return, which I'll just make the interest rate for the graphical position. And then thought about people, in fact, deciding their consumption, deciding their portfolios given rates of return. So that's a general equilibrium model. It's a perfectly fine general equilibrium model. That's what would happen on our little island economy if every time you left a coconut in the ground, RF coconuts sprang up tomorrow. Technology would then determine the interest rate, and the endogenous question would be consumption today and tomorrow. So if that were the general equilibrium, then both for the individual and the economy, the interest rate would be the exogenous thing. The consumption growth today and tomorrow would be the endogenous thing. And the function of our equation, our P equals mx, would be in fact determining consumption, determining the composition of the market portfolio, rather than determining asset prices in a true exogenate fashion. Well, neither of these is true, of course. Truth, a real model, looks something like this. Case 3, reality. In fact, there is a production possibility frontier, which is curved. As we plant more and more coconuts, the rate of return that we get out of those coconuts is lower and lower. So the production possibility frontier works like that. And the economy settles in an equilibrium that looks like this with an interest rate. And everything's endogenous. And that is the way the world works. Now, given that that's our world, and in fact, everything's endogenous, is it wrong to proceed as we have and think of consumption as determining asset prices? There's a theorem that says no. What we've done is just fine. It's not wrong. It will not give us wrong predictions about the world. Suppose that we live in a true economy that I've given you in the blue, but we model it as an endowment economy. And we send our statisticians out who do a very good job of figuring out what equilibrium consumption turns out to be, and then plug into our computer models as if it was an endowment economy. Well, as you can see, the black line and the blue line generate the same interest rates and the same consumption. So if you model the equilibrium consumption process correctly, there's no error. There's no error in your predictions about how consumption and asset returns move over time by imagining it were a Lucas economy. Similarly, if you model the rates of return correctly, if you model the stochastic process for rates of return, their conditional means, their conditional variances, there would be nothing wrong in writing down that economy and studying the relationship between rates of return and consumption, even though it's really generated by a general equilibrium economy like that. What would go wrong is, of course, if you start making statements about causality, about what happens if we start taxing returns, what happens if we have a technological shock. Those sorts of things would go wrong. Same thing. We have taken our betas as exogenous. We've thought about the covariance of consumption growth with returns as determining expected returns, but nothing of the sort is true. Let's write out expected returns as covariance of discount factor with tomorrow's return. And even if we think the dividend is exogenous, a fixed cash flow, which we just model, well, tomorrow's price is as endogenous as can possibly be, and tomorrow's consumption reflects consumers' expectations of future returns, consumers' expectations of the future. That's as endogenous as it could possibly be. So this stuff is endogenous as well. Is this hopeless? No. The bottom line of this thought is, first, price equals expected discounted payoff. It's a condition that must hold. It's part of a general equilibrium. It's a demand curve. Well, demand curves have to hold in general equilibrium. Price equals expected discounted payoff, just looking at the demand side and not really worrying about supply, is very useful in many applications. And the bottom line for finance is not theoretical purity. The bottom line is, have you found a theory that is useful in the application at hand? You can often stop there and not worry about the general equilibrium foundations. But beware in doing so about using words like explain, cause, endogenous. Beware about making general equilibrium statements of what would happen if technology changed out of a model that doesn't get the right general equilibrium. People use those words, especially the explain, all the time, and they're usually using them wrong. Third, it's interesting, and we will close the course by thinking about real general equilibrium models. The real model of finance specifies, yes, demand, the utility function, but also specifies the supply, the technological production possibilities, the investment opportunities, how new companies are formed, and is the shocks are truly exogenous shocks, things like technology shocks, taste shocks, shocks to market structure, things that are truly exogenous and move around the supply and the demand curve. That's a hard task. Macroeconomics really hasn't come up with one, and these exogenous shocks remain ephemeral. But that, of course, is the only kind of model that you're going to be able to use if you really want to talk about explaining, causing, and exogenous. For the moment, keep in mind that what we're looking at is a first-order condition. It's a demand curve. It does have to hold, but the bottom line is whether it's useful. So let's put this all together. What have we done in this unit? We started with price equals expected discounted payoff, and we rearranged that with a few lines of algebra in lots and lots of interesting ways. We talked about returns in both discrete and continuous time. We re-expressed price equals expected discounted payoff into statements about expected returns, covariances, and betas. And we derived the look of the famous beta models that are throughout finance. We got the famous theorems that covariance matters for risk. Only systematic risk is priced by looking at that. We found the mean variance frontier. It exists and is expressed by the Rolle theorem. Returns on the mean variance frontier carry all pricing information, even when nobody wants to hold a return on the mean variance frontier. We talked about random walks and martingales and market efficiency and the time series behavior of returns. And we also learned about the possibility of slow time varying expected returns. And we closed up with thinking about general equilibrium, how prices expected discounted payoff is really a demand curve that needs to be merged with a supply curve if you want a true picture of what's exogenous, what's endogenous, and what causes what. Those are really the topics of the entire course. Most of the to-do list is to go back and look at each of these items in much more detail and understand them more carefully. Along the way, we're going to also look at more asset pricing models. We saw one where we substituted discount factor is function of consumption growth via power utility function. But that one, it turns out, doesn't work very well in practice. And our goal is to find models that work well in practice. So we'll abandon a lot of theoretical purity and we'll think about other ways of connecting discount factors to data that are useful for specific applications. The capital asset pricing model connects the discount factors to the market return. The Fama-French model connects the discount factor to the return on larger sets of portfolios. We'll do lots of models that connect the discount factor not to true macroeconomic quantities, but to other prices. So option pricing and bond pricing models, pricing by arbitrage, you find very useful models, though not that pure models, from learning about the discount factor for one set of assets by finding discount factors that price other sets of assets. And that's very useful, not so much when you want to have lunchroom discussions about rationality and exogeneity, but very useful when you have a set of prices and you want to learn how to price a bunch of other things. We'll survey the facts and how the theories, once we develop them, account for the facts and don't. And of course, we'll talk about portfolio theory. What does all this theory, in fact, imply for how in the modern world one should form a portfolio of assets? That's the to-do list, but really it is go back through everything we surveyed today and look at it in more detail, more carefully. And I hope this preview made it exciting to go back and look at each of those items.